Picture a vast, towering pyramid made entirely of monthly $10 bills. That's roughly what you're imagining when you think of how an insurance company stays in business. You hand over a modest sum each month, your neighbor does the same, and when disaster strikes, the company simply cracks open the piggy bank and pays out from that growing pile of cash. It feels intuitive. It feels dreadfully obvious. I'm afraid it's also completely and utterly wrong. Do forgive me. Where are my manners? I'm frightfully pleased you've decided to join me. Allow me to explain. The myth that keeps the whole misunderstanding alive is the notion of the shared piggy bank. The idea is that insurance is simply a massive group savings account. You put in a fiver, your neighbor puts in a fiver, and when a storm flattens your garage, the insurer begrudgingly hands you back your share. It suggests that premiums and payouts are basically a one-to-one exchange. You pay for the promise of a payout, and that's the end of the story. If that were true, every time a bad storm season rolled around, every insurance company on the planet would instantly go bankrupt. The reality is far more elegant. An insurance company isn't actually a piggy bank. It's a precision engine for managing mathematical odds, and it makes its money through two entirely distinct mechanisms. The first relies on the simple arithmetic of risk, and the second is something you've likely never even realized is happening behind the scenes. Let's untangle the first mechanism. It's called the underwriting profit. This is the money the company keeps after collecting everyone's monthly payments and paying out all the claims for the year. The trick to understanding this is grasping how they set the price of your premium in the first place. You see, an insurer doesn't just guess what to charge you. They employ battalions of people called actuaries. An actuary is a professional fortune teller who uses brutal, unyielding mathematics instead of a crystal ball. Their entire job is to calculate the exact probability that you, specifically, will crash your car, drop your phone, or have a tree fall on your roof. They crunch vast amounts of historical data to figure out the statistical likelihood of something dreadful happening to you over the next 12 months. Let's say an actuary calculates that out of every 1,000 people exactly like you, 10 of them will have a serious accident costing $10,000 to fix. If you divide that total potential cost by the 1,000 people in the group, it comes out to $100 per person. That's the baseline cost of your risk. If the insurer charges everyone exactly $100, they'll have precisely enough to pay the 10 unlucky souls who have accidents. But if they only charged exactly that amount, they wouldn't make a single penny. So they add a margin. They might charge you $120 instead. That extra $20 isn't for the repairs, it's the company's profit margin. When you multiply that $20 margin by hundreds of thousands of customers, you're looking at a rather handsome underwriting profit. So far, so simple. It's still vaguely resembling a piggy bank, just with a clever mathematical toll taken out. But here's where the myth begins to fall apart. What happens if the actuaries get it wrong? What if an unexpected storm flattens garages for 200 people instead of 10? The company suddenly has to pay out vastly more than it collected in premiums. The piggy bank is empty and it's running at a catastrophic underwriting loss. If insurance companies relied solely on collecting slightly more than they pay out, they would be utterly bankrupted by a single bad year. And yet, they don't go bankrupt. In fact, they post record-breaking profits. How perfectly absurd. This brings us to the second mechanism. It's called the float, and it's the absolute secret to the entire insurance industry. The float is the colossal mountain of cash the company holds that doesn't belong to them yet. When you pay your monthly premium, that money doesn't go into a locked vault to sit idle. It goes straight into a massive central pot. But remember the nature of time. You're paying them today for an accident that might happen tomorrow, next month, or next year. Right now, in this very second, they're holding billions of dollars of your money, and they don't have to pay it out in claims until the future. It's a breathtakingly clever trick. They have a vast reservoir of other people's money just sitting there. So, what do they do with it? They invest it. They take the float and pour it into government bonds, corporate debt, and property. They buy shares. They aren't gambling wildly, of course, because regulations demand they keep the pot relatively safe, but they're earning a steady, massive return on money that technically belongs to you. Imagine having billions of dollars to invest in the market, and imagine you didn't even have to work to earn that principal amount. You simply collected it from your customers. The interest and dividends generated by the float are staggering. This investment income is the true engine of the insurance company. This completely flips the myth on its head. Because the investment returns are so massive, an insurance company doesn't even need to make an underwriting profit to be wildly successful. In fact, a smart insurer might deliberately charge you slightly less than the mathematical cost of your risk. They might know they're going to pay out $110 in claims for every $100 they collect. They do this on purpose. Why? Because it makes them terribly competitive. By undercutting their rivals, they attract millions more customers. More customers mean a bigger float. A bigger float means more billions to invest. The returns they make on the stock market easily eclipse the petty cash they lose on the underwriting side. So, the next time you receive your renewal notice, you can smile knowing you're not paying into a glorified savings account. You're handing over capital for an investment syndicate. They use your money to buy government bonds, pocket the handsome returns, and then, if you're unlucky, they'll use what's left over to repair your roof. It's really quite marvelous. Now then, I dare say there's a lingering question rattling around in that clever head of yours. If their entire business model relies on taking your money and investing it, why do they make claiming a payout feel like you're wrestling a grizzly bear for the last salmon? The answer is rather pedestrian, I'm afraid. Every dollar they pay out to you is a dollar they can no longer keep in the float, generating those sweet market returns. It's in their absolute financial interest to delay the payout for as long as legally possible. The longer your money sits in their pot, the more interest it earns for them. It isn't personal. It isn't that they harbor a secret grudge against your flooded bathroom. It's simply cold, unyielding mathematics. A swift payout is an inefficiency. A delayed payout is an opportunity for another month of compound interest. So the big, scary insurance industry is really just a giant, incredibly patient investor that uses monthly premiums as its swingeous source of capital. Quite right. It's an elegant system, even if it feels a bit ghastly when you're the one waiting for the check to clear. And it certainly makes a great deal more sense than a giant piggy bank. Tell me this, my dear viewer. Have you ever had a claim dragged out for what felt like an eternity, and now that you know about the float, does it suddenly all make rather infuriating sense? Do say so in the comments below, where I read every one, and the sharper ones occasionally change my mind. If this was worth your 9 minutes, the like button is how you tell me so, and it costs you nothing but a twitch of the finger. Send it along to whoever in your life grumbles loudest about their premiums. And should you fancy having the next explanation arrive without hunting for it, the subscribe button handles that admirably.